Hello. Before diving into today's post, there are a few things that I want to discuss that we've been discussing here on the podcast in the last few weeks. Firstly, yesterday we saw the United States and China come to an agreement to reduce the tariff rate that they were imposing on one another. As I stated a few weeks ago, in industries where the US and China are heavily interconnected, tariffs to the level that were being imposed would heavily hurt the United States. Since the Chinese has said that they wouldn't back down, such a back down was going to have to come from the American side. And as I predicted a few weeks ago, we have seen that come to fruition. Also last week, in my episode discussing the latest clashes between India and Pakistan, I stated that the likely path forward was de-escalation because the Pakistanis were heavily incentivized to pursue such de-escalation. Over the weekend, we saw a ceasefire announced, and this de-escalation does seem to be sticking currently. So if you want more scenario analysis such as this, make sure that you follow on the podcast platform of your choice or head over to Substack, where you can subscribe to get all of these blogs straight to your inbox. Okay, with that covered, let's dive into today's topic. Since January, we've seen elevated levels of volatility in financial markets as a consequence of Trump's ranging rapid-fire policy strategy. We have very clearly seen this represented in the VIX, which is a volatility index for the S&P 500. We've also seen volatility in gold charge upwards in price, while on the flip side, we've seen the price of oil falling. Today, we're going to dive into potential reasons why these moves have occurred and what some of the longer-term impacts of such moves could be. One of my favourite Benjamin Graham quotes, who is one of the most legendary stock investors in history, is that in the short term, the stock market is a voting machine, and in the long term, it is a weighing machine. This has been clear since Trump re-entered office, as we've seen short-term price action driven by sentiment and emotions. This has been as clear as day in the gold price. Gold reached an all-time high of around $3,500 per ounce in April. For anyone who bought gold before this rise started occurring in 2023, their investments could be up close to 100%. The reasons for such a historic charge in the price of gold are a combination of geopolitical, economic, and financial factors that have all aligned simultaneously. These factors include the following: central bank purchases of gold, geopolitical volatility and rising tensions, government debts rising, the return of inflation and the highlight of monetary policy issues, and the purchase of gold by Chinese consumers to hedge Chinese economic struggles. When we collect these reasons together, the sharp price rise in gold can be boiled down to uncertainty. One of the biggest examples of this uncertainty came when the United States confiscated Russia's foreign exchange reserves that were held in dollars when Russia invaded Ukraine. When this occurred, the entire world took note, but especially the BRICS nations, because if this can happen to Russia, it could also happen to anybody else, especially nations who are seen as adversarial to the United States. Regarding the dollar, The dollar won't die overnight. It will actually be far from this. But this confiscation of FX reserves has started a trend where nations are seeking hedges and safe havens from the dollar. One of the safest of safe havens is gold, and so we've seen central bank purchases rising dramatically. The precious metal used to be a part of the global financial system back when we had a hard-backed currency system. This means that a currency, the dollar in this case, could be exchanged for a fixed amount of whatever backed that currency. In the case of the Bretton Woods system that was formulated at the end of World War II, the currency system was backed by gold. After Nixon ended the gold standard, the dollar then became king of the hill in the floating rate currency system that fluctuates depending on supply and demand that we know today. The slow end of the dollar as the global reserve currency is one key narrative that potentially frames where our global financial system could be heading. However, there are alternative approaches that the Trump administration could be pursuing. For those who have read or listened to this series from the beginning, you'll likely gauge where I fall on most issues involving the Trump administration's approach to leading in the United States. But one thing that can't be denied is that the current system needs to change. And for this to occur, sometimes parts need to be cut off and reattached or regrown in a new form. The Trump administration is pursuing such moves. The success of these moves will be told with time, but it's clear that with rising government debts and inflationary issues, that change to the system is required. If there is a Trumpian grand strategy play being made here, what evidence could we have to support this? Firstly, Trump has imposed tariffs on a wide range of goods, but he hasn't touched gold. Why would Trump not impose tariffs on gold is the next question that popped into my mind. This reason could be twofold. Firstly, it could be because Trump doesn't plan on selling US gold. And secondly, because the Trump administration could see the unhappiness of many nations in the current global system, and so they are in pursuit of creating a fairer system. So, what impact could this have on the United States? Firstly, it seems that Trump is trying to redirect flows of dollars into the United States. As I stated last week in my discussion on tariffs, a rising dollar makes exports more expensive and imports cheaper. Trump has made imports more expensive via tariffs, but he is also pushing for a cheaper dollar, which would make exports cheaper and would incentivize a boost to US manufacturing. Part of such a deal to incentivize exports could also involve potential currency deals with other nations that would see the value of their nation currencies rise against the dollar. The tariffs also play further into this. Trump wants more investment via infrastructure, weapons, factories, tariffs, or gold. Regardless of Trump's message to buy stocks now that he has been peddling over the last few weeks, this investment that did usually end up being pumped into US financial markets is now attempting to be redirected towards more physical assets. This would reduce dollar flows into the United States that we've seen prop up the value of the dollar so heavily. The last example of this was during COVID, when the dollar index rose as the US dollar acted as a safe haven asset. Are we now potentially entering an era where, just as Nixon closed the gold window, Trump could be aiming to close the financial markets window? Now, this could backfire. Trump could get played. He has increased negative rhetoric of the Russians in recent weeks because they aren't playing ball in the pursuit of a ceasefire in Ukraine. And the Chinese could heavily benefit from a system where the renminbi becomes more internationalized. Gold's rise also has the potential to improve the financial situation of Chinese consumers. This would give the US and China another lever to pull in managing the yuan-dollar cross rate, which will likely grow to become one of the most important financial tools in our future world. Now, to end this section on gold, if we bring the focus back to Trump and the United States individually, we should ask what Trump's overall aim is here. Yes, Trump could say that he is in pursuit of a fairer world, but we know that Trump loves a deal and that he is incentivized to gain something from such deals that he makes. This could well be connected to the fact that Trump wants to eliminate income tax for those who earn less than $200,000 a year. This is Trump's typical voter demographic, but eliminating income tax for those who earn below $200,000 could also expand Trump's support outside of his usual demographic, especially when the cost of living and inflation remain issues in the United States that continue to affect consumers. Trump has also stated that he is interested in a third term. Now, this could be to ruffle the feathers of the Democrats, but what incentive does Trump have to peddle such a narrative? It's likely because he wants to remain relevant and powerful. Now, time will tell how this narrative unfolds, but if he pulled off such a strategy of reducing income tax for a large majority of Americans, his opinion amongst Americans could improve dramatically, and when the next election rolls around, who knows where we could be. Now, I quickly want to return to discussing the VIX. The VIX is a measure of market volatility, as I stated in the introduction, and it tracks the expected volatility over the next 30 days in the S&P 500, which is a collection of the 500 biggest companies in America. When the VIX spikes upwards, it means that the daily candle on financial charts has a much larger average range from top to bottom. During COVID, the VIX spiked to above 80, and as is seen on the chart, volatility also spiked sharply during April when Trump proposed his sweeping tariffs on Liberation Day. This led to market turmoil and triggered a rapid global sell-off, especially in the S&P 500 and the Nasdaq, which is the technology index. Both the S&P and the Nasdaq experienced their steepest two-day declines since COVID. This was worrying because Trump was hoping to raise money through tariffs, but the financial markets erased $6.6 trillion in market value. This could potentially explain why Trump is calling for investors to buy stocks, because if the money that he is trying to save through various measures, including the Department of Government Efficiency, tariffs, and other strategies, if all of these pursuits are written off by stock market losses, then what was the point in pursuing any of these strategies in the first place? We saw volatility remain elevated as trade issues between China and the United States came to the forefront in the aftermath of the Liberation Day tariffs. However, over the last few weeks, we have seen volatility start to fall. As I discussed in the introduction, we've seen the US and China agree to reduce tariffs on one another, and this led to a dramatic rebound in the stock market. So, The reason that I bring up the VIX here is because I believe the VIX will act as a proxy for the success of such trade talks between China and the United States. But we also have to keep an eye on the VIX due to uncertainty that remains through Trump's policies. It's this uncertainty that, in my opinion, means that more spikes in the VIX can't be ruled out, and hence we should keep an interest on the VIX and see where it heads over coming weeks and months. The final element of financial markets that I'm going to discuss in today's episode is oil. Now, Trump wants cheap oil. This, first of all, which is an aspect that I didn't mention in the blog, this would allow Trump to refill the strategic petroleum reserve that was emptied during Biden's administration as he attempted to lower gasoline prices during the period of inflation. The strategic petroleum reserve gives the administration another tool to use to potentially lower inflation. This could be especially useful for Trump if tariffs do lead to inflation spiking in certain sectors. Lower oil prices in general that Trump is in pursuit of would lead to cheaper gasoline prices and energy bills for Americans, while also reducing the inflationary pressures that I just spoke of. It could also reduce input costs in sectors such as chemicals, steel, and transport, which could incentivize another increase in manufacturing within the United States. Cheaper oil could also hurt geopolitical adversaries such as Iran and Venezuela, who rely heavily on oil sales. But the elephant in the room here is that most shale producers within the United States struggle to be profitable when crude is below $60 a barrel. We're now hovering around that area, so Trump could have a balancing act on his hands. He could achieve this via tax incentives to the oil and gas industry, regulatory reform, or an increase in energy exports, especially to Europe. Trump has been in discussion with the Russians about restarting gas flows to Europe. It's debatable if the Europeans would even accept such an offer, but this could highlight that Trump is in pursuit of cheap energy independence for the United States, which he then wishes to export to the rest of the world. A big question that emerged for me here when I was exploring Trump's pursuit of cheap oil is why OPEC is going along with this. Specifically, OPEC wouldn't have done this and agreed with Trump to lower oil prices unless they were benefiting somehow. Cheap oil would weaken their income, which is especially notable when many OPEC nations rely heavily on oil incomes. So, did Trump make a deal with the Saudis? He did pursue a ceasefire with the Houthis in Yemen, but this alone can't explain why one of the world's biggest oil giants would go along with such a US proposed deal. So, what other potential reasons could we have that OPEC is standing in line and allowing the United States and Trump to pursue cheap oil? The United States has been pushing for an expansion of the Abraham Accords, which normalizes relations between countries in the Middle East and Israel. Currently, Trump and Netanyahu aren't the best of friends, with Trump believing that Netanyahu is attempting to manipulate him. This is definitely a possibility. Netanyahu remains in office through his far-right coalition, which is pushing for war with Iran and more aggression in the Gaza Strip. Netanyahu has to push himself and his coalition further and further down this far-right political scale to stay in power. Nothing would help appease his coalition more than war with Iran, and nothing would appease them even more than if this war with Iran was backed by the United States. Now, if such an Abraham Accords deal was to occur with the Saudis, I believe this is currently highly unlikely. The Saudis have stated that Palestinian statehood is required for any expansion of the Abraham Accords, and with Israel stating its plans to take over the entire Gaza Strip, this distances us further from Palestinian statehood, making a deal unlikely at this current point. Another potential explanation for OPEC allowing Trump to pursue cheap oil could be that the Saudis have been pushing for an American security guarantee for many years. Trump has shown interest in pursuing such a policy in the past. This would give the United States more investment that Trump is currently seeking, and there is definitely room for a deal here, which we could see unfold over the next few days as Trump is currently visiting the Middle East. A final potential place where a deal could be formulated is Saudi nuclear enrichment. In the past, this was conditional on normalization with Israel, but a few days ago, Trump said that this is no longer the case. Now, it may never come out that the true nature behind this deal for reduced oil prices, but if such a deal does exist, Trump could let something slip during this visit to the Middle East. In the broader energy sector, many analysts are in agreement that Chris Wright is one of the most qualified energy secretaries the United States has ever seen. He is a key part of the necessary nuclear push and states that current policies aimed at reducing the impact of climate change, namely renewables, are misguided. If the pursuit of lower oil prices involves Chris Wright, then there will be reasoning behind it. Now, to conclude, in this new uncertain world that we've entered into, Trump is certainly having an impact on financial markets. But the impact he's having is less about the financial aspects and is more a consequence of Trump's wide-ranging policy, all of which can be summed up as a grasp for power as we enter into a new power-based world order. But Trump is currently playing a high-stakes game, and on occasion, even a deal maker can get outplayed. Next time, I'll delve further into the wider effects of some trends that we've seen emerging in the stock market, specifically exploring cryptocurrencies, the spike we saw in some Asian currencies last week, and the chances of recession in the near future. If you enjoyed this episode, make sure you leave a review on the podcast platform of your choice. I've been Dylan. I'll talk to you next time.